the ripple effect on everyone else. This isn't about just your family budget. It's reshaping the entire economy. When millions of parents funnel money into supporting adult kids, the ripple effects spread across housing markets, retirement systems, and beyond. Let's explore how these private financial choices are altering America's economic landscape. First, the housing market. Young adults traditionally become first-time homebuyers in their early 30s, but that's changing. Bank of America reports that 50% of Gen Z is delaying homeownership, often because they can't save for down payments while relying on parental support. This creates a chain reaction. Fewer first-time buyers mean fewer existing homeowners can sell and upgrade. The result: a sluggish market where prices remain high, but transactions slow. In Maplewood, New Jersey, for example, 40% of starter homes are now purchased by parents for their adult children. Local realtor Mark Chin explains, "We've got 55-year-olds co-signing mortgages for 30-year-olds who make six figures. These aren't trust fund kids. They're professionals like engineers and teachers whose salaries can't keep up with decades of rising home prices." The retirement crisis compounds the issue. Parents spending $1,384 monthly on adult children aren't saving for their own futures, which means less money circulating in the economy later. Economist Dr. Teresa Gallardici warns this could lead to a generational wealth collapse, projecting $6 trillion in lost consumer spending over the next decade as undersaved retirees cut back on expenses. Other industries feel the ripple effects too. The auto industry, for instance, has seen a 22% drop in auto loan applications from under 35s over the past 5 years. Many young adults rely on parents for cars instead of buying their own. Some dealerships even market directly to parents with promotions like family discount packages, where parents foot the bill while their kids make token payments. Similarly, the wedding industry has adapted to financial dependence. The average marriage age has climbed to 30, not because people are maturing slower, but because many can't afford weddings without parental help. Wedding planners report that 62% of couples now rely on parents to cover costs, with some parents paying the entire bill while employed couples save nothing. Even the job market reflects this dynamic. Employers recognize that many young workers have parental safety nets, which allows them to offer lower wages. A Silicon Valley CEO admitted anonymously, "We budget for junior salaries knowing their parents probably pay their rent." This depresses wages across entire industries, making it harder for young adults to achieve financial independence. Healthcare costs are also affected. Young adults staying on parental insurance plans until age 26 drive up premiums for everyone. Insurance actuary David Park explains, "Young healthy adults subsidize older risk pools. When they stay on parents' plans, premiums rise 12 to 18% for that group." Parents often keep their children on corporate plans as long as possible, only to face sticker shock when transitioning to individual plans. The travel industry has shifted as well. Resorts and cruise lines now market multi-gen vacations, where parents pay for entire families. A Carnival spokesperson notes, "We see 30-year-olds who've never booked their own trip." Similarly, grocery delivery services target parents sending food to adult children in other cities. One Instacart user, 58, regularly sends $300 weekly grocery orders to her 27-year-old son, whose $85,000 salary goes toward concerts and ski trips instead. The student loan crisis perpetuates this cycle. Parents who co-sign loans often continue making payments to protect their own credit. This creates a perverse incentive. Young adults don't feel the financial strain, and as one 29-year-old admitted, "Why fight for a raise when my mom's handling my $700 loan payment?" Even the stock market feels the impact. Bank of America reports that 46% of Gen Z isn't on track to invest within 5 years. Parents sacrificing their 401k contributions to pay kids' rent means less money flowing into equities, reducing future capital for economic growth. These ripples extend to the gig economy, where apps like Uber and DoorDash thrive on workers who can afford low wages because parents cover their real expenses. One 26-year-old DoorDasher shared, "This pays my fun money. My dad handles my student loans and health insurance." Finally, the fertility rate ties into this economic shift. Young couples delay having children longer, partly because they remain financially dependent. The average first-time mom is now 30, up from 21 in 1970. Demographers warn this could accelerate population decline, straining Social Security and Medicare systems. The choices families make today don't just affect their own budgets. They ripple outward, reshaping industries and the economy as a whole.